Hello and welcome back to another Camtasia video lecture. In this video we're going to go the through the exercises that you have to do for your study guide. So the first one we have to do is exercise 9-1, and it's on page 433 of your textbooks. So in this exercise, they want us to prepare a flex budget. So right off the bat, we know what a flex budget is, right? We know a flex budget is what the costs should be based on the actual driver, right? Or the actual output, okay? So we have Puget, I guess, Puget Sound Drivers. It's a company that provides driving services such as underwater ship repairs, and they give us the information for May. They give us their planning budget in the book. So if you notice, they give us the budgeted diving hours, 100, the revenue we would get for that, and all the expenses that we incur. Notice they give us the cost formulas and the revenue formulas. Okay, so we're going to present this information in flex budget form, right? It's just an income statement. That's all it is, but it's based on actual results, looking at what the cost should be. Okay, so in proper form, we always want to make sure we put the name of the company, Puget, if I'm pronouncing that right, Puget Sound Divers, and this is a plan. What we're going to do is the flex budget. So we say this is a flex budget, and it's for month ending, for the month end did May, say May 31st. Okay, so the first thing we need to do is we need to put in what are the actual diving hours. Well, they're 105. Just bear with me here for a second. I apologize, I'm kind of anal when it comes to making sure the charts and the financial statements and whatnot are in proper form and look nice. Okay, so first thing we're going to do is figure out what should our revenue be based on actual performance, right, or the actual output or the actual driver. To do this, we need to know what's the revenue formula. Well, it's 365 Q. Well, in this case, Q is the 105. So our revenue, $365 times 105 diving hours, if my math's right, should give us 38,325. Okay? Now we can go ahead and do our expenses, right? Just like a normal income statement. But all we're doing is doing some analysis, or setting up the flex budget so we can analyze what the costs should be based on 105 diving hours versus what the costs actually were based on 105 diving hours. So the first thing we're going to do is our wages and salaries, and I'm just going to abbreviate. Okay, we need to know what is our cost formula. Well, it's easy. It gives it to us right in the book, right? Oh, sorry. It's 8,000 plus $125 Q. Well, the 8,000 is the fixed portion of this cost. The $125 is the variable portion of this cost. So we say $8,000 plus $125 times 105 hours gives us $21,125 of wage expense, or wages and salaries. Great. Now let's look at supplies. I don't know what supplies you would need to dive and fix a boat, but I'm sure there's some. And they tell us that the cost formula for this is $3 times our quantity. And this is a true variable cost, right? And remember the definition of variable costs. In total, variable costs change in direct proportion to changes in levels of activity. However, on a per unit basis, variable costs remain constant. So we're going to take our $3 worth of supplies times 105 diving hours. We get $315. Oh, sorry. $315. Okay. Let's look at equipment rental. So apparently we need to rent some equipment. And it usually helps if you can spell, huh? Equipment rental. What's our cost formula? Well, the cost formula for equipment rental is $1,800 plus $32 per diving hour, or $32 times Q. So we can just plug and chug, right? This is a prime example of a mixed cost because we have a fixed portion and a variable portion. This is just like wages and salaries. We solve it the same exact way. Take the fixed portion and then we add the total variable portion. Total variable portion is going to be the 105 diving hours times the $32 per diving hour. Then to that we add the total fixed, which is the $1,800. We end up with $5,160. Next we have insurance. Right? Need insurance. They tell us that the insurance is $3,400 per month. That's it, right? Insurance is fixed. It's going to, in total, it's going to remain constant as long as we're within that relevant range. So 105 hours is definitely within that relevant range. Our insurance did not change at all. We're just going to carry over the $3,400. The last one we have is miscellaneous. All right, miscellaneous expense. No idea what that is, but they incurred some miscellaneous expenses. They give us the cost formula. Cost formula is $630 plus $1.80 times the driver. Okay, so $630 plus $630 plus $1.80 times 105 gives us $819. So our total expenses are going to be $30,819. So what's our NOI? That's our net operating income. Well, to figure that out, we take the revenue of $38,325 and we subtract our total expenses, $30,819. We end up with $7,506. Okay. The key takeaway from this is how to put together a flex budget. Number one, got to know that the flex budget involves the actual driver or the actual output, right? That's the 105 diving hours. Second thing you got to know is that you're going to get a cost equation. And that cost equation is either going to be fixed mixed, or variable. The third thing you got to kind of take away from this is this is what the revenue, the expenses, and the net operating income should be if we managed the operation efficiently. Okay, so let's look at the second one, or the second exercise we got to do. That is exercise 9-2, and it's on the next page. It's on page 434. And what they want us to do here is they want us to go ahead and prepare an activity variance report. Okay? So right off the bat, before we even dive into this, you got to know, when we do activity variance, we're looking at the planning budget versus the flex budget. That's how we calculate activity variance. Okay? And we're going to put this in proper form. So we have Flight Cafe here, in-flight meals for airlines in its kitchen located next to a local airport. Okay. So we're a cafe that makes in-flight meals that we sell to, I guess, the airlines. Okay. They give us the planning information, the planning budget, 18,000 budgeted meals. They give us the revenue, the expenses. Then they give us the flex budget. Okay. The flex budget is based on 17,800 meals. Okay. So what we need to do is recognize that first we got to set it up in proper form. So this is Flight Cafe. This is the activity variance report. And this is for looks like the month ended of July. Okay. Usually helps if 4. There we go. And we'll just say July 31st. Okay. So the first thing we need to recognize is that we're creating activity variance, right? So what does that mean if we're creating activity variance? Well, that means we need to pull together the flex budget and the planning budget. The difference between those two gives us our activity variance. Okay, pretty simple, pretty easy. Bear with me, I want to just make this look a little neater here because I don't think we have enough room in there we go. Okay, so the first thing we need to do is figure out how many meals are we preparing. Well, based on the flex budget, the problem tells us we're preparing 17,800 meals. Okay. Planning budget, the static planning that we did, we said, you know what? We're going to plan for 18,000 meals. Okay. So right off the bat, we have 900, an activity variance of 900 unfavorable. Okay. Why is it unfavorable? Well, we planned for 18,000, but based on the flex budget, we actually only prepared and sold 17,800. So we're unfavorable. So the next thing we're going to do is we're going to figure out what's our revenue. Okay? And they give us the cost formula for that. It's the $4.50 times the Q. $4.50 Q. Now, do I really need to take 17,800 times $4.50 and 18,000 times $4.50? No. Here's why. They already gave us the information. They already gave us the calculations. We don't have to calculate anything for this point, right? So we see that the meals for the revenue for the flex budget is $80,100. For the planning budget, it's $81,000. And again, that's just taken the quantity of meals times the cost or the revenue that we earn. Okay, so right off the bat, we can see here that we are, $900 unfavorable, right? Let me go back up. I misread my notes, sorry. Here we're 200 meals unfavorable. Okay. So the revenue is unfavorable. Why? Because we made $900 less than what we actually planned to do. And again, that's a result of the difference in the meals, the 200 meals. So now we go through and we look at each of the expenses. Okay, very easy for us to do. Let's look at the first one, which is the raw materials. I'm going to abbreviate and say RM, right? What's our cost formula? Well, the cost formula is $2.40 times the quantity. Well, for the flex budget, the quantity is 17,800. So I'm going to take 17,800 times my $2.40, which gives me 42,720. Do the same thing for the planning budget. We said 18,000 meals for the planning budget. Based on a raw material cost of $2.40, $2.40 times the 18,000 gives me 43,200. So right off the bat, we're $480 favorable. Why are we favorable? Well, because look at the flex budget. Based on the actual level of activity, we incurred a raw materials expense of $42,720, but we budgeted for $43,200. So we're $480 favorable. Why does that exist? Well, because we're comparing the flex budget based on actual performance, what the numbers should be, based on this static planning numbers. Okay, so let's look at the second expense that we have, and that's wages and salaries. So for wages and salaries, what is our cost formula? Well, it's 5,200 plus 30 cents Q. Okay. Oh, sorry. 0.3 Q. Okay. Now, this might seem redundant to you, and it is, but there's a reason behind the madness. Okay. We don't need to plug 17,800 in, substitute 17,800 for Q, calculate it, and figure out what the number is. The problem, the book already gave us that number, right? It is 10,550, right? Same thing for planning budget. I don't need to take the 18,000 meals, plug it into that equation, and calculate the number, because it was already done for us, right? The book already did it, 10,600. The reason why I keep repeating it is because I want you to kind of make sure that you completely understand the fact that we need those cost equations. They're going to be given to us. We got to plug in our activity into each of those cost equations. Okay, so that's one reason for the redundancy. The second takeaway from this activity, or yeah, the second takeaway from this is twofold. Okay, number one, making sure you know that the activity variance is used, or to calculate the activity variance, we got to use the flex budget and the planning budget. That's number one. Second thing is knowing or being able to recognize, is it favorable or unfavorable, and then going back to the reason why is it unfavorable. So let's look at wages and salaries. Right off the bat, wages and salaries, there is a $60 difference. Okay, well, let's think about that. Based on actual output, our cost for wages and salaries should be $10,540. We planned, based on 18,000 meals, for our wages and salaries to be $10,600. So that's a difference of $60, right? We're favorable because we spent less than we had planned to spend. But again, the reason for this difference is because the difference in activity, right? Those 200 meals that we had planned for, we didn't hit that production level. We fell $200 or 200 meals short. Okay, so let's look at the third one, which is utilities. What's the cost equation? Well, for utilities, it's $2,400 plus 5 cents per meal. Okay, so if the book didn't give me the answer, I would have to take 17,800 meals, plug it into that equation of 2,400 plus 0.05 times Q, which we'd substitute as 1780. Don't need to do that. Book already gave me the answer. It is 3290. And I do the same thing for the actual budget, which ends up being 3,300. So when I look at those two, there's a $10 difference, right? Am I favorable or unfavorable? Well, it's going to be favorable. How do you know that? Because the flex budget is less than the planning budget. So we're $10 favorable. Again, what's the reason for that? Well, the difference in activity, right? If we produced, let's say we actually prepared 18,100 meals, then all our expenses would be unfavorable. In this case, we produce less meals than we had actually planned, or we actually produced less meals than what we had planned. So that's why the majority of our expenses here are going to be favorable. Okay. Rent. Rent, they tell us, is a fixed cost of $4,300. Well, based on actual activity, the cost for rent should remain the same, $4,300. Same thing with the planning budget. That's what we planned for. So there's no difference. There's no variance in rent. Okay. Then we get to insurance. Well, the insurance, they tell us, has a flat fixed rate of $2,300. Well, based on actual output, the cost for insurance should be the same, $2,300, right? Same thing with the planning budget. It's fixed. We're within the relevant range. So we have no variance there. Then we get to miscellaneous expenses. And they tell us that the fixed expenses are $680, or the cost formula for miscellaneous expenses is $680 plus 10 cents per meal. Okay, so I plug that in and I end up with 2,460. Under the planning budget, well, it's 2,480. There is a difference of $20. Now, is that difference favorable or unfavorable? Hopefully you said favorable. Why? Because the flex budget is less than the planning budget, so we are favorable here. Notice when we're comparing activity, or when we're looking at activity variance, again, using the flex budget and the planning budget, we're going to have variance whenever there is either a variable cost or a mixed cost, right? And that makes sense because we know how mixed costs behave. So now we got to figure out what's total expenses. And total expenses are $65,610 under the flex budget. Under the planning budget, they're $66,180. So just looking at total expenses, are we favorable or unfavorable? Well, based on actual output, these are what the costs should be. We are favorable compared to the planning budget. We are $570 favorable. So what's our net income, or our net operating income? Well, that's easy. Remember, to figure out net operating income, revenue minus total expenses. Based on actual output under the flex budget, my net operating income should be $14,490. Based on the planning budget, that static number of 18,000, I'm saying my net operating income should be $14,820. There is a $333 difference. Are we favorable or are we unfavorable? Well, now we're looking at income, right? We actually produced less under the flex budget than what the static budget or what the planning budget says. So since it's less, we must be unfavorable. Okay? So let's look at the next example in the homework, which was example 9-3, or in the study guide, which was 9-3. And that is also on page 434. Okay? All right, so what do we got to do here? Well, here we have to calculate the revenue and the spending variance. Okay? So right off the bat, when I'm calculating revenue and spending variance, I know that I need the actual results compared to the flex budget. That gives me my spending and revenue. Oh. Why did I do that? I apologize. Jumping all over the place here. Sorry if I made you sick. Okay. Revenue and or spending and revenue variance. Okay, so right off the bat, when they say, hey, you got to do revenue and spending variance, how do you do it? Well, you know that you need to have your flex budget and the actual results. Okay? So what's the first thing I need? Well, first thing I need to figure out is, what's my driver, right? In the problem, they say pounds. Pounds are our driver. So pounds, which equals that's our Q. We actually sold 8,000 pounds of oysters. Well, guess what? Under the flex budget is what should the cost be based on the actual output? So it's going to be 8,000. Okay. So let's look at revenue so we can figure out what's our revenue variance. Well, what is the cost formula? Well, it's $4 times RQ. Okay, that's easy. 8,000 times 4 is $32,000. So based on $8,000, our revenue should be $32,000. But what is it actually? Well, if we look at page 435, they give you the actual income statement. So we're going to use those numbers for our actual column. They tell us that our revenue is actually $35,200. So we have a difference, right? We actually earned $35,200 in revenue based on the flex budget of $8,000. We should have earned $32,000 in revenue. So there's a $3,200 difference. Are we favorable or are we unfavorable? Well, we actually made more than what the flex budget said we should have. So we're favorable. Okay, so now let's go ahead and look at our expenses. So now we can go ahead and do calculate the spending variances. Okay, so let's look at the first one, which is packing supplies. What's the cost formula there? Well, it's 50 cents times the quantity. Okay, that's easy enough, right? So based on the flex budget of 8,000 pounds, how much should I have incurred in packing supplies? 4,000 bucks. Okay, let's look at the income statement on page 435. How much did I actually incur in packing supplies? $4,200. Am I favorable or am I unfavorable? To answer that question, again, we have to say, what did we actually do, or what expenses did we actually incur versus what expenses should we have incurred at the actual level of output. So there's a difference of $200 and it is unfavorable. It's unfavorable because we actually incurred more than what we had planned on incurring. So right now we can say, okay, why are we $200 unfavorable? What happened? Well, so maybe some packing supplies got ruined. Maybe the packer's using too much packing supplies. Whatever. Okay? Well, we can take steps to correct that and fix it, and hopefully next time it's back in line, right? All right, let's look at oyster bed maintenance. So they tell us that the oyster bed maintenance has a flat fee of $3,200. So right off the bat, that's a fixed expense. So based on the flex budget, our expense should be $3,200 for oyster bed maintenance. What did we actually incur? We actually incurred $3,100 in maintenance. So we have a $100 difference. Are we favorable or are we unfavorable? Again, what did we actually incur versus what should we have incurred based on the flex budget? Well, we actually incurred $3,100, should have incurred $3,200. We are favorable. Okay, let's look at the next one. Wages and salaries. We're doing the same exact thing, right? Meaning, taking our cost equation. What's our cost equation? 2,900 plus 30 cents per pound, or 0.3 Q. Okay, based on the flex budget, what should my wages and salaries be? it should be $5,300. Okay, well, what are my actual results? Again, I got to go to the income statement, and I see that my actual results are $5,640. Okay, am I favorable or unfavorable? Well, right off the bat, I know I'm unfavorable because I actually incurred more than what I had budgeted or what I should have paid based on actual actual output. So we're $340 unfavorable. Bear with me here. I fat fingered a key. Get rid of that U. It should be and, or the ampersand symbol. Next thing we got shipping. Okay. What are my shipping costs? Well, to figure that out, I got to figure out what's my cost formula. Well, it's 80 cents times Q. Okay, that's easy enough. So based on a flex budget, based on 8,000 pounds, which is actual output, what should my shipping cost be? Well, based on my flex budget, it should be 6,400. What did I actually incur in shipping costs? Well, it's 69.50. Okay, so right off the bat, I know I'm unfavorable. Why? Because I actually incurred more than I should have according to the flex budget. So I am $550 unfavorable. Again, we have an unfavorable variance. We can look at it and ask why, and then we can do some research and figure out why we paid more in shipping than we should have, right? Maybe our shipping costs are off, right? Maybe it's not actually 8 cents per pound or 80 cents per pound. Maybe it's more. I don't know. Maybe we were late getting out some shipments and we had to overnight them. Maybe there was a problem in the warehouse. I don't know. Next thing we got utilities. And utilities is a fixed amount of $830. Okay, what did we actually incur in utilities? $810. So there's a difference there of $20. Is it favorable or is it unfavorable? Well, we actually incurred less than we should have incurred based on the flex budget, so we're favorable. Okay, why? Well, we'd have to research that, right? Maybe when we were budgeting our utilities, maybe the fixed amount we chose was too high. That could be a possibility, right? Okay, the next one, or the last one we have here, is the other. All right, those will be our like miscellaneous. So here, the cost formula is 450 plus 0.05Q. So based on the flex budget, what should our other expenses be? Well, they should be 850. Okay. Oh, sorry. 850. But what are they actually? Well, they're actually 980. So right off the bat, we're unfavorable. Why? We actually incurred more than we should have based on that flex budget. So we're $130 unfavorable. So now we can total up our expenses. And if I just add up all the expenses, I see that the actual expenses are $21,680. And under the flex budget, the total expenses should be $20,580. That means that in total, I have an $1,100 difference. Am I favorable or unfavorable? Well, the actual results were higher than what the flex budget said, so I'm unfavorable. Okay? Let's figure out net operating income. Again, revenue minus total expenses. The actual net operating income is $13,520. The flex budget net income should be $11,420, and our variance is $2,100. Favorable or unfavorable? it is favorable. Okay, so why? Well, I got a hodgepodge of things going on, right? Right off the bat, I earn more revenue than I should have. Good. The expenses are kind of a hodgepodge, right? Some of them are unfavorable, some of them are favorable. But in essence, my increase in revenue, meaning the difference between what I actually incurred, or what revenue I actually earned versus what the flex budget said I should have earned, was higher and offset the difference between the favorable and unfavorable variances with the expenses. Okay, so that, my friends, is how you excuse me, is how you do 9-34. The next thing to do is 9-4. 9-4 is super easy, okay? And you might say, why? Well, I'm not going to go through the whole thing, but I'm going to show you how to set it up, okay? Because I think if I go through it, it'll just be too easy, and I want to give you guys a little bit of a challenge, right? So what am I doing here? Well, basically what I'm doing is I'm putting together the activity variance with the spending and the revenue variance. Okay, so I'm putting all three variances in one report. Okay, how do I do that? It's very, very, very easy. The first thing you got to do is recognize, how do I set this up? Okay, so it's very easy, and let me show you how to do that. Okay, so you're going to want to manipulate these just a little bit, just to get some room there. And I'll show you what we want to do here. Okay, so the first thing that always goes here, and again, this is the Flex Budget Performance Report. This is what we're doing. Flex Budget Performance Report. We always start with actual results. Okay. Oh, so sorry. We always start with our actual results. Okay. And the first variance that we want to figure out is our revenue and spending variance. Okay. Well, remember, in order to do the revenue and spending variance, we have to compare actual results with the flex budget results. Okay, so you'll put in your actual results. You'll use your cost formulas, which the problem gives you in the book, and you'll calculate the flex budget. The difference between, I'm going to do it this way for you. This will be column A. This will be column B. So we'll say spending and revenue is the difference between column A minus column B. Okay, pretty easy. Now, I apologize, I messed up here a little bit. We need to go ahead and add. Damn it. We need to add a column here. Actually, if you just highlight this column and just insert to the left, that'll work out perfect for us. Okay, so now we have column A, column B, and now we need to do column C. Well, column C is going to be our planning budget, and that goes all the way at the end. And this is going to be column C. Oh, why'd you do that? Column C. Okay, So in between the flex budget and the planning budget, well, that is how we get the activity variance. And to figure that out, we just take column B minus column C. And we can tell what our activity variance is, okay? I'm confident that from this point, you guys can bang this out. If you're having trouble, just text me, not a problem. I'd be happy to set up a big blue button session and run through, review how to calculate revenue and spending variance, how to calculate activity variance, and go from there. Okay. So you're good now. I will go ahead and post this video. After you complete this, obviously turn it in, and then you can go ahead and move on to the pre-built Connect problem and the quiz for chapter 9. Okay, so if you have any questions, again, please do not hesitate to shoot me a text. I welcome text. I love it when you guys text me. I get excited. I'm sorry, that was kind of weird. But no, I enjoy working with you guys and talking with you. And if you need any assistance, I'm more than willing to help out. You just got to let me know. Okay. All right. So good luck this week, and I'll be talking to you.